In this video I will be sharing an amazing strategy using 2 RSI to enter strong pullbacks in a trending market. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, let us understand what the RSI is. The RSI stands for Relative Strength Index. The RSI is a momentum indicator that shows the current price of the asset compared to the recent price action. It helps us in understanding whether the price is overbought or oversold levels. The RSI is an oscillator. Therefore, it moves from 0 to 100. When the value of the RSI falls below 30, it is said to be in an oversold region. Therefore, you can expect the price to make enough money of. On the other hand, if the RSI goes above 70, it is said to be in an overbought region. Hence, we can expect the price to make it down move. One thing to note here is that the price will not always respect the overbought and oversold levels. For instance, in an uptrend the price can stay in an overbought region for a long period of time. On the other hand, in a downtrend the price can stay oversold for a long time. So cannot blindly use the overbought and oversold signals on the RSI for our trading. But I have noticed that in an uptrend the price respects the oversold levels. Similarly, in a downtrend the price tends to respect the overbought levels. This information is very crucial for our strategy. Now we'll use a second RSI indicator to identify the trend of the market. A popular way of using the RSI for trend is by using 60 and 40 levels as overbought and oversold levels on a higher time frame. So in this strategy our main trading time frame is going to be the 15-minute chart. Therefore, you can plot the RSI and select a higher time frame for the RSI calculation. For this strategy we will set the calculation of this RSI to daily time frame. We can do that by going into Indicators settings and selecting the daily time frame. We will also change the overbought and oversold levels to 60 and 40 respectively. When the daily RSI is trading above the 60 level, we will consider the price to be in an uptrend. And when the daily RSI is trading below the 40 level, we will consider the price to be in a downtrend. So these are the 2 RSIs that we will use in our strategy. The RSI used for trend calculation will be called as the daily RSI. Its color will be blue. And the regular RSI that will be based on the current time frame will be referred to as the RSI. The color of the regular RSI will be purple. Now let's look at the rules of buying and selling. So here are the rules for buying. Rule number 1. We want the daily RSI to be above 60. When the daily RSI is above 60, this shows us that price is in an uptrend. Rule number 2. The current RSI should be below 30. When the current time frame RSI goes below 30, it provides us a great opportunity to winter long on the long-term uptrend. So we'll look to buy when the RSI is below 30. Rule number 3. Enter long when the RSI closes above 30 level. We will enter the buy position when the RSI closes above the 30 level on the chart. Let's look at a trade example to understand this strategy. So here on this chart we first need to identify the trend. We can see that daily RSI is well above 60 level. So can confirm that the price is in an uptrend. Now wait for the current RSI to give us a close below 30. On this candle, we see that the value of the RSI was below 30. This shows us that the price has made a downwards pullback in the price. We expect the price to respect the oversold level and make a higher move. But we will not enter the trade on the candle. Instead, we want the RSI to close above 30 level. Here on this candle, we see that the RSI closes above the 30 level. This shows us that the RSI has now again shifted the momentum to the upside. We can enter on this candle. We can keep our stop loss below the recent swing low. We can keep our targets at 1:1.5 risk-reward ratio. As you can see, we achieved a target on this trade. Now let's look at the rules for selling. Rule number 1. We want the daily RSI to be below 40. When the daily RSI is below 40, this shows us that price is in a downtrend. Rule number 2. The current RSI should be above 70. When the current time frame RSI goes above 70, it provides a great opportunity to win a short trade on the long-term downtrend. So we'll look to buy when the RSI is above 70. Rule number 3. Enter short when the RSI closes below 70 level. We will enter the sell position when the RSI closes below the 70 level on the chart. Let's look at a trade example. So here we see that the daily RSI was well below the 40 level. Therefore, we can confirm that the price was in a long-term downtrend. Now wait for the current RSI to go above 70 level. On this candle, the current RSI closes below the 70 level from above. This indicates that the momentum has started to fall downwards. So we'll enter on the candle. We will keep our stop loss above the most recent swing high, and we will keep our targets at 1:1.5 risk to reward ratio. And we made profits on this trade. That brings us to the end of this video. Here we have shared with you an amazingly simple trading strategy using only 2 RSIs. With this strategy, I am not saying that you will make profits on every trade. But this strategy can give you an extra edge over the markets. The main logic behind this strategy is that we will look to win to the long-term trends. Needless to say, you still need strong risk management and discipline to execute any strategy. With a strong risk management, you can make profits with any strategy. The same is the case with this strategy. The market will present a lot of trading opportunities with this strategy. Your goal should be to only trade those opportunities that suit your risk management. I suggest you to test it for yourself before investing real money into it. So if you like this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos.